Investment Banking Explained. An Insider's Guide to the Industry. Preface. Investment banking is a complicated industry of traders, analysts, brokers, managers, hedgers, quant jocks, retirement planners, and yes, even bankers. This business is as creative as it is mechanical, as qualitative as it is quantitative. Its clients range from middle American mom and pops to international billionaires, from newly created firms to multinational giants. Investment banks also work for governments. The business of an investment bank is to deliver a broad range of products and services to both issuing and investing clients. Its offerings go from strategic advice to the management of risk. In the last century, the main purpose of an investment bank was to raise capital and to advise on mergers and acquisitions. Investment banking services were defined as either underwriting or financial advisory. We tend to use a broader definition today. This is how J.P. Morgan describes it. In the simplest terms, investment banking helps companies decide on their marketplace strategy. Investment banking also provides access to public and private investment-grade debt, high yield, and bank markets for a wide range of high-profile clients, from governments and multinational companies to family-owned companies and individuals. Investment banks also trade for their own account, and many are involved in managing third-party assets. The largest investment banks have been around for more than 100 years, some of them even for 200 years. However, their business has changed tremendously in the last 10 years, as investment banks have innovated at a furious pace. This is probably why they still exist today. For as all organic beings are striving, it may be said, to seize on each place in the economy of the nature. If any one species does not become modified and improved in a corresponding degree with its competitors, it will soon be exterminated. 40 years ago, if one could ensure operational risk, investing on the stock market was rather like taking a bet. The stock market was the realm of speculators. In the 1960s, a new approach and new mathematical models, which could be run with recently invented computers, allowed financial service companies to develop revolutionary diversification techniques to manage the financial risk of investing. A good way for the investment banks to show their mettle in managing risk was to acquire asset managers. Over the last decade, however, the approach to risk has changed. Investing in diversified assets is still a tenet of money management, but a new approach has transformed the financial markets. Instead of diversifying the risk among various assets, investment banks now slice them up and package them into bits that trade on markets. These bits, which we call swaps, derivatives, CDOs, and credit default swaps, allow the transfer of risk from one party who cannot manage it to another party who wants it. With this new approach to risk, investment banks have taken on more risk, and they have changed the mix of their business. They are now investing their own capital and trading more innovative products, and they have taken on more risk, and they have moved away from the pure intermediary approach of their previous business model. This new way of doing business has, not surprisingly, created new kinds of conflicts of interest between the investment banks and their clients. In any of the big investment banks, 10K fillings with the Securities and Exchange Commission, there are tens of pages on pending legal claims from customers or regulators. In the late 1990s and early 2000s, evoked many scandals in which investment banks were involved. Think of Enron, Global Crossing, and WorldCom. the telecommunications giant that filed for Chapter 11 bankruptcy protection in 2002 with $30 billion in debt. Moreover, before that, there was the collapse of the 200-year-old Barings Bank, one of the ancestors of today's modern investment banks, and the bankruptcy of Orange County. In fact, no current-day business segment of investment banking has gone unscathed. Research and the scandal involving Solomon Smith, Barney, and Merrill Lynch in 2001, trading and the collapse of long-term capital management, fixed income and the bankruptcy of Orange County, or the special purpose vehicles that Enron used to disguise its debt. Equity issues and the IPO allocation scandal involving Frank Quattrone at CSFB, the big mergers that turned sour like Daimler, Chrysler, and AOL Time Warner, the 2003 mutual fund scandal involving Janus Capital Group Incorporated, Strong Financial Corp., and Putnam Investments, owned by Marsh and McLennan. These scandals have been exposed by dozens of books, and the investment banks have been easy targets for many scathing articles in the business press. Because investment banks are difficult institutions for outsiders to understand, and there are a few books that explain how they function, we know only the dark side of the picture without comprehending much else, let alone the whole picture. To begin with, do you know the difference between investment banking, investment banks, and merchant banking? Or everybody talks about globalization, but how do investment banks work outside of Wall Street? As a potential client, how do you choose a bank that is going to create value for you, not for itself? Or on a professional level, if you want to work for an investment bank, what can you expect? This book tells how investment banks work most of the time, very efficiently, and why they have survived. This book is a guide to investment banks. It explains the strategies of the global investment banks. It reviews how investment banks are organized and the interdependency among the various areas. I begin with the long-term history of investment banks, long before Wall Street, and then go on to describe the various business of investment banking, taking time to illustrate two different but arguably equally successful strategies, those of Merrill Lynch and Goldman Sachs. We then travel across the capital markets around the world, and I explain how the banks develop their international strategy. The various markets mechanisms are described, and it is interesting to see how the investment banks have influenced the consolidation of exchanges and electronic venues. The book then analyzes the strategy in each of the main functional areas of an investment bank: client relationship management, equity research, equity capital markets, debt capital markets, M&A, and third-party asset management.